So we are going to go over Chapter 8 on the week off and talk about receivables. So I'm going to cover the highlights of this chapter that I want us to focus on. Now we've talked about various types of receivables. The most common that we are aware of is the accounts receivable, which is a current asset. Usually it derives from customers owing us money. So in this scenario, amounts due from individuals and from companies that are intended to be collected in cash. So this can result from the sale of goods or services. There also can be a written promise, which is called a trade receivable by customers. And then we would have things such as non-trade receivables. These are not specifically related to the ordinary operations of a business, but it would include interest, possibly loans, income taxes that are to be refunded, various receivables that would be on the book. Now, we've got current receivables and long-term receivables that we'll talk about. As you see here, regarding the financial statements of several companies, you can see that General Electric shows 52% of their total assets relate in receivables. Ford is at 42%, 3M's only at 14%, and we're down to Intel that's sitting at 5% of their total assets are in receivables. So that's why we're going to talk about this subject. The two items to spend time on relate to when we recognize receivables and how we value those receivables. So when we're dealing with a service entity, they predominantly, their operating income is derived from providing a service. Now, service organizations record that receivable when the work has been performed. Merchandising companies will record a receivable when there's a sale. And we know oftentimes the sale on merchandise usually happens when that product is delivered. Assume Jordache on July 1st of 14 sells merchandise on account to Polo for $1,000. The terms, 210, net 30. So basically, if the company pays the bill within the first 10 days, they're allowed a 2% discount. We're supposed to come up with a journal entry. So we know our debit is to accounts receivable as this increases our asset, and our credit is to sales revenue for $1,000. Now on July 5th, Polo returns merchandise worth $100 to Jordache. So we would show a debit to sales returns and allowances, and we would credit because we're reducing our accounts receivable by that amount they're returning. Then on the 11th, Jordache receives payment from Polo for the balance due. So as you see, the cash is at $882 because they took advantage of the discount. The discount will only be on the actual inventory they are or the merchandise they're purchasing. And so we took into account the $100 that they returned. That would not be part of that. So the 2% discount would be on the $900, which would be the $1,000 they initially purchased minus the $100 in returns. So we would show a sales discount here of 18, and we would credit in full our accounts receivable for $900. Now there are entities out there that have their own credit cards. And JCPenney is an example. TJ Maxx is another example. Boy, they want me to get that credit card. So when they, a customer purchases the items with the credit card for $300, then we would show a debit to accounts receivable, a credit to sales revenue. Now, let's say at the end of the month, there is a 1.5% balance due. They would increase, because of interest, they would increase the accounts receivable of $450, and they would credit here an interest receivable. This part is not part of the sales revenue. This is a result of the interest they are collecting as a result of the credit card and the credit balance. So know that those companies that do have their own credit cards would show that additional interest receivable as a result of their credit cards and the financing that they are providing for you. Now, regarding accounts receivable, generally speaking, those accounts are expected to be paid in the current operating cycle. So we would list the accounts receivable as a current asset. Now, the piece regarding valuation is we will want to show only the net realizable value because of our allowance for uncollectible accounts. So even though accounts we hope will be paid in full, they're not always. So usually based on some history, we're going to have an allowance that we create for potential bad debts. There are two methods that are used to account for these bad debts, those debts we don't anticipate to collect. One is through the direct write-off method, and the other is through the allowance method. Now, the allowance method is what is required by GAAP, so that's really what we're going to focus on in this chapter, although we will lightly touch on the direct write-off method. So basically, the way the accounts are set up is similar to the assets less the accumulated depreciation where we show net assets. The same is true here where we'll have an accounts receivable, and we'll also have in some ways what we would call a contra account as the allowance for doubtful accounts. So those are sitting on our books. Of course, accounts receivable is a debit and our allowance is a credit. Well, we would combine those for the balance sheet. So we show the accounts receivable at a net receivable. We take into account the allowance for doubtful accounts on our balance sheet. So there's different ways it can be done. We can show that allowance or we can show the net amount. This again is in the current assets section of the balance sheet. So a journal entry for a credit sale of $100 would show a debit to accounts receivable, and it would show a credit to a sale. As you see here, we're posting them to the various T accounts, showing the sale and showing the receivable. Now, we collected $333 on the account. We would increase our cash, and we would decrease the accounts receivable by that amount that was collected. Now, we show an adjustment for estimated bad debt, so we would debit our bad debt expense and then offset that by our allowance for doubtful accounts. Again, as you see, we do continue to post that to our various T accounts. Now, when we choose to write off the account portion that we deem uncollectible, at that time, we will debit our allowance for doubtful accounts, and we will credit our receivable to get that receivable off the books, since we know we won't be collecting it. So as you can see here, we'll show, again, our updated balance in our accounts receivable, net of the $30 allowance we now have. So as we deal with the direct write-off method, we're going to go through an example here. It's not the ideal method for GAAP purposes, but we will look at this. Warden writes off Emmy Doran's $200 balance as uncollectible. So basically, at that time, they'll debit that bad debt and credit the accounts receivable. We don't set up an allowance for those uncollectibles. Now, when we set up the allowance, companies are going to come up with previous history of what their uncollectible amounts are. So it's an estimate. And when we have that estimate, we'll then debit our bad debt, credit our allowance. And then when we know an account is not going to be collected, at that time, we'll debit our allowance and credit our accounts receivable to get rid of that item of uncollectible that we know we're not going to be receiving. So an example here shows Hampson Furniture, shows credit sales of $1.2 million. 200,000 of those remain uncollected at December 31st. The credit manager estimates that 12,000 of these are going to be uncollectible. So we'll show a bad debt expense of 12,000 and we'll credit our allowance for doubtful accounts for 12,000. Now remember, that bad debt expense will be part of the income statement. The allowance for doubtful accounts is a contra account to our accounts receivable and will show up on our balance sheet. So as you see here, the balance sheet shows the net receivables. They take into account our allowance. So now the Vice President, on March 1st, 2015, authorizes a write-off of the $500 balance owed by R.A. Ware. So at this time, we'll debit our allowance for $500 and we'll credit the receivable to zero that out. So we know it's uncollectible, we're getting rid of it, but we will debit our allowance for doubtful accounts to come up with a new entry, or excuse me, a new balance in our allowance. Now let's say the $500 we initially wrote off is being paid by Ware. So we need to show an entry to reinstate that accounts receivable for $500, credit back that allowance for doubtful accounts of $500, then we'll show our increase in cash and our credit to accounts receivable by removing that accounts receivable. Now, basically, most companies will come up with an estimate based on a percent of receivables that will be uncollectible. So they'll look at the past history on the accounts and then from there determine what amount of that will be uncollectible. Here you see an aging of accounts receivable where we show the amounts that are due and then we show the number of days that they've been past due. We know that as the account ages, the chances of collecting those accounts become greater and greater. So as you can see here, 2% of those amounts not yet due we deem to be uncollectible. As it moves on to over 90 days, 40% of those are going to be uncollectible. Assume the unadjusted trial balance shows an allowance for doubtful accounts with a credit balance of $528. So we're going to prepare the entry assuming $2228 is the estimate of the uncollectibles. So as you see here, the allowance has a credit of $528. We're going to show a bad debt expense of $1,700, a credit to our allowance for $1,700, because that figure will then increase our allowance for doubtful accounts to the $2,228 that we desire. So let's look at this problem here, see if we can figure this out. Brühl's been in business 5 years. The unadjusted trial balance at the end of the year shows a debit to accounts receivable, a credit to sales revenue, and then we have a debit to our allowance for doubtful accounts. So we know our net receivables here would be 32,000 because our allowance has a debit as of right now. Bad debts are estimated to be 10% of receivables. We're supposed to prepare the entry so we can adjust that allowance. So if we anticipate our bad debts are going to be 10% of the receivables, then that means our allowance needs to be a credit of $3,000. So in order to come up with a credit of $3,000, because it right now has a debit of $2,000, we're going to need to debit our bad debt expense for $5, credit our allowance for doubtful accounts for $5, and as a result, that will give us that $3,000 allowance we like. Now, there are notes receivable that basically are a set amount of money that will be paid at a specific time in the future. This sometimes happens when we lend money to people, or it could be a customer that just is really not current on their balance, but they want to pay it, and so we'll remove that accounts receivable and provide a note receivable for the customer. We generally show it in a written form as a promissory note, and we have in here showing the note, the date, the amount, the date it's due, the payee, which will be the individual to whom the money is being paid to, the interest rate, and then the maker of the note. Now, the maker of the note will be the individual who owes the money. Notes get expressed in terms of months and in terms of days. So when we compute our interest, we need to be cognizant of the fact that the annual interest rate is in terms of an annual year. And we'll need to look and compute the interest based on months or days. So as you can see here, a $730 note at a 12% rate that is due in 120 days, we would need to show that over the 360 is what we're going to show days in a year, not the 365. So we'll take the amount of the note, we call the face, times the interest rate, the annual rate, and we'll multiply that times the time outstanding. In numbers of days, we'll take the 120 days that it's due and divide that by our number of days in a year to come up with the interest that will be owed on that note. Likewise, when we look at a 6-month period, we can use months to determine this rate. So we take our face amount, the $1,000, times our annual rate of 9%, and multiply that times 6 months over 12 months in a year to come up with our interest. Then when we're dealing with just an annual year note, we can just take the face amount of $2,000, multiply that times our annual interest rate of 6%. That's how we're going to calculate our interest on the notes. So as we see here, Brent wrote a $1,000 2-month, 8% promissory note, dated May 1st, to settle an open account. So in order to show that, we would debit our notes receivable for $1,000, and we would credit our accounts receivable because we're getting rid of that accounts receivable and replacing it with a notes receivable. Now, we always show our notes at the net realizable value because we're going to take into account any allowances that we're going to deem for doubtful accounts, just like we do on our accounts receivable. Once a note's been paid off, or unfortunately if they default on the note, we're going to need to then dispose of our notes on our books. So the way in which we're going to show the notes being paid off, in this case, we've got a company, Wolder, that lends Higley at $10,000 on June 1st. It was a 5-month 9% interest note. So Wolder presents the note on November 1st and pays it. So we're going to show our cash. We're going to credit our notes receivable for $10,000. And you can imagine the difference is going to be the interest that we've received on this note. Now we'll calculate that interest by the face amount, $10,000, at the annual interest rate of 9%. And we'll take the terms of the note, 5 months, divided by 12 months in a year to calculate our interest. There are times at the end of a period we may need to accrue our interest receivable. So let's say Wolder prepares a financial statement on September 30th, and the adjusting entry is for 4 months of interest ending September 30th. So what we would want to do is show that interest that's being accrued. We would show an interest receivable of $300 for the previous months. We would show interest revenue of $300 because we have earned that money just with the passage of time. So this is as of September 1st, how we would accrue those previous 4 months. Now, Wolder makes a record honoring the note of Higley on November 1st, so we've already taken into account some interest receivable we've shown on the books. In that case, we will have to credit our interest receivable to offset the interest we've already accrued on our books. And there's only 1 month that we haven't accrued for, the month of October, so we would then show our interest revenue for just that month on the books. So as you can see, the interest receivable here will have been credited because we were accruing that interest during the months. So basically, how do we go about managing these receivables? Well, we want to know that if we are going to extend credit to someone, they're credit worthy. So we want to first determine who it is we will extend credit to. We've got to come up with some type of payment period and plan. We need to carefully monitor these collections so that way we can do the best we can to get those collections in a timely manner. And then look to see the liquidity. How reasonable is it that these receivables are being paid in a timely manner? And then from that, do what we can to get the cash from those receivables as soon as possible. Remember, accounts receivable is a current asset, and it is intended to be transferred into cash, but the sooner we can do that, the sooner we can then go out and purchase more merchandise. There's a tough balance with credit sales because many people operate on credit. So if we have a policy that's really too brisk as it relates to credit, we're going to possibly lose some sales to another common vendor. But on the other hand, if we've got too lax of a credit policy, then they might not pay. So we really need to make sure we fine-tune that credit policy that will work according to our situation and our customers. So in determining a payment period, we really need to communicate any type of payment to the customers so they are fully aware of what is expected of them, and it should be in line with what our competition is doing. We need to monitor them. Always keep a list of the aging receivables so we can see where we have potential issues. And then from there, when we evaluate the liquidity of the receivables, basically what we're doing is looking at a couple of the ratios and seeing how our receivables are in sync with previous periods and then also with other competitors in the same sector. So as you can see here with Nike's information, we've got the sales for each year, 11 and 10, and we've got our accounts receivable. So from there, we can perform some ratios. Our accounts receivable turnover ratio takes our net credit sales, divides it by our net accounts receivable, our average. So we usually take the beginning and the end, add them together, divide it by 2, and we can see how quickly we're turning over our accounts receivable. So as you can see with Nike, they turned their receivables over 7.2 times, which is a little faster than they did in 2010. That was only 6.9 times. But look at the industry average here, 12.2 times. So they're definitely behind the industry average. Then from there, we can take the average collection period, which basically is, in this case, 365 days we'll use, and we divide that by our accounts receivable turnover to really equate that in terms of days. So you see here in 2011, Nike collected their receivables every 50.7 days, but look at the industry average, 29.9 days. So they're definitely behind the industry average. So definitely something to look at, the various turnovers, to see the liquidity, how quickly we turn that into cash. 3 reasons you would want to accelerate the cash receipts: because the size of the receivables is significant. There's also companies out there that will sell the receivables in order to get cash sooner than later. So they basically sell their receivables in the form of a factor. Now, I'm not going to spend much time talking about that in this chapter because you'll have plenty of other opportunities in other classes to deal with factoring. Now, when we're talking about credit card sales, this is relating to Visas and other credit card sales. So we've got an example here where Morgan purchases $1,000 of compact discs for her restaurant, and she charges the amount on her Visa. Now that Visa is going to charge the seller a % for using the Visa. So basically what happens is the seller or the company is not going to be able to collect the entire amount of that purchase. They may collect the remainder, and we would show the difference as a service charge expense, kind of a banking expense for doing business. So we would show our cash, we would debit also our charge expense, and we would credit then the sales revenue. So that's really the key issues I want to focus on in this chapter. We'll take a look at some problems next.